Traditionally in supply chains, the goal has always been to optimize in terms of service level. However, a few years ago at Lokad, we came across the potential of a radically different approach, which optimized in terms of the economic implications of a decision. As such, today on Lokad TV, we're going to discuss this financial analysis and how it means you can compare apples to oranges. So Janice, I'm not sure how we've made it this far without discussing kind of economic drivers. So what's the whole idea behind this?
It fits in the sense that most of the problems in supply chain are driven by the tail. So what happens, tail events. It's the unexpectedly high demand that generates the stock out. It's the unexpectedly low demand that generates the inventory write-off. In the middle, well, things just work fine. Inventory rotates gently. I would say asset utilization is just what it's roughly expected to be. So everything is nice. It's when you go to the tail that things start to get progressively bad until it's completely ugly. And so the thing is, if you focus on the middle, it doesn't tell you much. Service level is already steering, I would say, your focus to a sort of tail. It steers the focus on your quality of service and the few percent of time of the situation where you don't serve your clients according to expectations. So service level is a step towards something that is a bit closer to the real pain. But then if you want to really balance, for example, the fact that when you have high quality of service, you might, at the end of the season or at the end of the year or at the end of, I would say, this generation of products that you're selling, you might end up with inventory write-off. You need something to balance. And indeed, you have apple and oranges because on one side, you have write-off that are quantity of units, and then you have service level, which is quantity of requests that you will serve in time, from according to your service level agreement or whatever you've agreed with your clients, even if it's like implicit agreement. So bottom line is that when we started to look at the various constraints, the various, and then when you want to steer, also what the decisions that you want to take towards something that is aligned with strategy, we realized that we had no way but to express everything in dollars or maybe euros and then optimize it from there. But we need to have like a unified monetary target. Otherwise, we can't even do the optimization. To do an optimization, you need a target, and if you want a target that can be, that can apply cross-functional for the entire company, well, it has to be a monetary target.
Okay, so how does this actually work in practice then? Like, what do you actually mean by optimizing kind of a dollar of decision and a dollar target?
So the way we think of it is that, let's say, for example, you want to source a few more, units of a given product that you're going to transform or sell. So basically, you're passing a purchase order for one of your supplier. At the moment you're doing that, you're basically anticipating some future demand that may or may not happen. It's an anticipation. You're also anticipating, some certain lead time that may or may not happen. Again, if you anticipate a certain demand at a certain point of time, if the goods after, for example, the seasonal peak, yes, you had correctly anticipated the demand, but the goods that you've just ordered arrived too late, and so basically you can't serve the demand. So there are multiple uncertainties, and if you want to basically assess the payback of your decision, you can, after the facts, look at how much, what was the cost of your purchase, what was the payback in terms of generated margin, what was the payback in terms of stockout penalty. So that's basically, it's not something that is strictly, that don't end up in your books, accounting books, but it's something that you modelize to reflect the fact that there is an incurred cost of not servicing properly the client, etc., etc. And you might even have, at the very end of the life cycle of the product, the inventory write-off where you actually lose the value of the product. And plus you have the carrying cost, plus you have, so those economic drivers are just the mundane, I would say, dollars that you would put on an action. So you look, you take the perspective of considering a very simple supply chain decision, and you just take the decision from its point of time, and you say, well, 1 year down the road, how do I assess whether this decision was profitable or not? I just factor in everything that is relevant to assess, the final score after the battle for this scoring.
Okay, so why is it so important to kind of take this dollar-driven kind of approach? It just kind of sounds like a bit of a soulless financial kind of a bit analysis. So why is it so important to take this approach?
I mean, there are two main reasons for that. One is just mundane, which is you have a numerical, optimizer. So literally any software doesn't matter what class of algorithm it is, it's optimizing something, numerically speaking, for your supply chain. But in order to optimize anything, you need to have like a target, a metric, something that you optimize. So you need to have this target, and if you have a non-financial target, let's say service level, it's completely one-eyed. For example, service level, if you can't really optimize anything because it's one way. More service level is always kind of better. But if you have super high service levels, you're going to end up having massive stock levels and massive inventory write-off. So you need to have the financial perspective if you want to encompass all of that. So that's the first pillar, is just to drive the optimization.
But the thing about service level is it's something that's being used almost throughout the industry. So why is it something that the industry is so kind of focused on? Why is it such an important KPI?
I mean, service level, I believe that, the prominence of service level specifically, and I will get back to the second reason, but the prominence of service level can be explained because literally it can be written in a like 2 or 3 line statement in SQL. So remember, modern supply chains really, modern digital supply chains started at the end of the 70s, beginning of the 80s, where basically companies started to introduce ERPs. The name was only found in the 90s, but basically when they started to introduce what would be later called ERPs to run their supply chains. And in a typical ERP, you have a table that contains the stock levels for every single product that you serve. So literally you have one table with product, stock quantity. That's like vanilla design. And then if you want to assess your average stock level, you're just going to count how many products have a 0 stock level and how many products still have, I would say, still have stock left. So literally in one line you can get a query that tells you what is your average service level today. You have 1,000 products, you have 950 SKUs that still have stock left. So you can say, okay, I have 95% service level, if I look at the total of my portfolio. So one of the reasons why it becomes so prominent, it was because it was literally trivial to do in most enterprise software, ERP software. And by the way, it's trivial with a relational database, but it's also trivial in Excel, which is good. So basically people can either do that in their ERP system, if the ERP system supports stock level monitoring. If the system can't, then they can also trivially do that in Excel. But the fact that it's like super easy was certainly a big fact in I would say the massive adoption of those practices. It's not necessarily that it's really what truly makes sense for companies.
Okay, a bit of a digression there. So we'll
Yes.
get back to kind of the main idea about like why is it then that dollar-driven approach is so important?
So literally, I mean, first, if you don't have those dollars, you don't know what to optimize. And again, if you look at service level, you're blind from one eye. You only look at the positive outcome of having higher service level, which is better service for a client. It's good, but you have downsides such as extra stock, extra carrying cost, extra shrinkage, extra inventory write-off. So you can't just say I'm going to go completely crazy on the service level. It's something where you have diminishing returns. If you have, let's say, 98% service level, maybe you need to double the amount of stock that you have to go to 99% service level, and you're only going to serve 1% more, better your clients. So there is strongly diminishing returns. So you need this metric to do the optimization. If you don't add the financial metrics, I would say in my book, it's not even possible to start optimizing which may come to a large surprise for many companies, because many companies think they are optimizing, but they don't even have a target. So in my book, they haven't even started to do an optimization because they are lacking some of the most basic ingredient for the optimization, which is a unified numerical target.
Okay, because the idea of using economic drivers, it's all very kind of logical. So why is it something that isn't more commonly used by companies? Is it kind of a case that nobody thought of it? Is it a case of it was very challenging and nobody could actually act on it? Why is it something that's not used?
So it's intriguing. I mean, if you look at the history of the 20th century, I think it was literally one of the major discovery of building those massive companies was to engineer at scale cost optimization, and basically when you do that you end up with mass production systems. I mean, literally most of the modern supply chain that we enjoy nowadays resulted from very smart financial optimization that steered most companies toward mass production. Why? Because you had like massive economies of scale if the supply chain and production is done right. It's literally production, supply chain, distribution. If you have and marketing, all of that. If it's done at scale and right, you can basically sell goods of a vastly superior quality for a vastly lower price, expand your markets, rinse and repeat, etc., etc. So, and it was very. I believe that the differentiation between, let's say, a mid-century, 20th century, company and a company that was the same sort of things, 1 century before, is that people were heavily paying attention to the financials. So it's definitely not new. But what happened was, with, I would say, the introduction of computer systems, people think, with computers, everything was better, but not necessarily. I mean, initially, especially companies that early on moved toward their supply chain toward computer systems, as we discussed in other episodes. With the barcodes and the advent of the barcodes and the advent of the relational database, you had something that was capable of lifting a lot of super clerical work, just to basically for bookkeeping, super basic things. But the problem is that the earliest computer systems could not do any kind of fancy numerical optimization. It has to be they had hard time to even keep up with literally just the basics, like keeping track of the stock was already a challenge. And thus those systems, you kind of eliminated all the financial engineering because, well, it wasn't exactly needed. And then all the tools that were developed, like for relational database, you interact with relational databases with, let's say, certain languages like SQL. SQL is a language to query and update, relational databases. This language is kind of shaping how you look at the problem, and SQL is very much steered toward, I would say, crude, create, read, update, delete, operations, super basic operations. Again, it's not engineered at all to do any kind of numerical, I would say, fancy numerical optimization. So the design is a bit at odds, and as a result, many companies were kind of moved away from those financial indicators that were very hard to actually inject in their IT system. So literally, it had to live on the side.
Okay, so if it's such a large kind of undertaking for some of these big companies to take on a financial analysis kind of at scale, kind of what are the areas they need to target? Where should they start? Is it really that big a challenge?
Yes, because most of the supply chain problems is that the curse of supply chain is that you tend to displace problems rather than to resolve them. So let's have a look at a specific example to clarify that. Let's imagine we are looking at a retail network. You have stores and you have stock on the shelves. The stock serves two purposes. One is servicing the clients. People walk into the store, they expect to find a product. The product is on the shelf, they find it, they can buy it, profit. The second purpose is that the store looks good. And usually you need a lot of stock so that the store looks completely, overflowing with goods. If you don't have that, well, your store looks like a bit like a Poland before, during the Soviet time, where you had stores that where all the shelves were completely empty, and it looks like sad and miserable, and your store is really unappealing. So the lesson, I would say, of modern retail is the store. It must look plenty, and so that there is a lot of appeal and gives you an incentive of buying the stuff that is there. So the stock, but you don't necessarily need all of this stock for servicing purposes. There is basically merchandising purposes as well. So if you start to have financial drivers, you're going to realize that maybe half of the stock is there for servicing purposes. Thus, all this budget should be assigned to, let's say, supply chain. But the other half, merchandising stock, is actually, it's not a supply chain expense, it's a marketing expense. I mean, you want to make your store more appealing. Maybe you could have, you can renovate your stores, or maybe you could do TV ads or radio ads or anything else. So there are plenty of ways, to make your stores more attractive without adding more stocks. So this budget should be maybe assigned to, let's say, the marketing department. But then, if you're optimizing, if you just optimize from let's say the supply chain perspective, you could just remove the stock that is only for marketing, because from my supply chain perspective, I only care about quality of service. I want for every dollar invested, how can I best serve my clients? If it's not worth it in terms of quality of service, not my problem. But if you were to actually reduce the stock to the point where you only need what it takes to offer a good service, the stores would lose a lot of their appeal, and then you would have a problem on the sales side and maybe for the marketing side. So you see, the problem is that usually you cannot just go for those, when you start taking those financial perspective, you can't just zoom into one aspect of the company and say, we are going to do an optimization here, because you need to take into account the whole picture. And the problem is that suddenly you realize that with your system, you might have tradition in place. Maybe the tradition was that all the stock was being carried by the supply chain department. So far, they were not doing any kind of financial optimization, so nobody really cared. There was a certain amount of stock in the stores. It had been stable for a decade or more. So, well, that was just the way it was, tradition. And then you start optimizing, and then you realize that the marketing realized that maybe tens of millions of dollars worth of stock are just going to end up in their budget. And their ambition for the year was to shrink the budget or something. And some people want to actually put, millions of dollars on their budget, and then you can imagine, sort of turf war that you're going to have, where people are not going to be pleased, and obviously it's going to go against egos. On the paper, it's going to look bad for certain managers. People are going to disagree on the way you count the dollars, and I mean, it's going to be tough, and it's not tough because of the technology. It's tough because when you start, discussing money with money on the table, discussion becomes very heated. It's just very human.
It's such a big undertaking then in doing sort of a financial kind of led analysis. It's got to have kind of a payback. So kind of what's the benefits of moving to kind of this economic kind of led approach, and maybe kind of how much does it change the processes of a company?
I mean, what's the benefit is literally profit. At the end of the day, the companies that survive are the ones that are the most profitable. If you have competitors that are, even if you are profitable, but your competitors are more profitable, if you look 1 or 2 decades down the road, they will be able to invest more, to have better products, better marketing. Just having companies in your area that happen to be more profitable than you is a threat, because that would mean that they will be able to invest more and ultimately get even better than you, and it's going to compound over time. So back to that, why should you do it is that, well, first, if you really care about your company, if you don't optimize your bottom line, what the hell are you optimizing? That's the core purpose of the company, of modern capitalistic companies, is to generate, wealth that end up measured through the profit that you kind of accumulate at the end of the year. And then it's not necessarily a big undertaking. That's the trick. It's not necessarily big. It's the sort of things that are difficult. It's difficult because it requires like fortitude. It goes, against the lazy way. And I say people tend to misunderstand. It's not like you need to work hard. Usually in large companies, people are working crazy hours, so it's not a problem of working harder in the sense of more hours. It's that it's another sort of difficulty. It's like it's something where you will have to go against tradition, you will have to go against status quo, you will have, as an employee, if you want to push these sort of things, to go against, against many other managers possibly. But the payback is just usually gigantic. I mean, if you take a situation where there is no financial optimization in place and you start to play that game, well, that's exactly what Amazon started to do, 2 decades ago, and nowadays they are a $500 billion company, and they are still growing super fast. So yes, I mean, when you start to play that games and you execute it correctly, it's not just the idea. You need to have like proper execution. But obviously, the company who start to do that, usually when their competitor don't react super fast, the one company that does it just happened to be completely, crushing the entire competition.
Okay, if we start sort of wrapping things up a bit then. So if I was an employee watching this in a company, why shouldn't I be intimidated by kind of the complexity of a financial optimization?
You should not be intimidated by the complexity, because it's not that complex. I mean, yes, supply chains are not infinitely complex in their economic drivers. Things that you buy cost money, transforming them cost money, moving them around cost money, distributing them cost money, and when you sell them, you make a margin, which is all your cost. It's your selling price minus all your cost, and you have your net margin at the end of the day. I mean, the drivers keeping things in stock cost money. The drivers are not, exceedingly abstract. This is not like advanced financial engineering, as if you were playing with advanced structured product on, I would say, commodity markets. So from this regard, the amount of financial engineering that is needed is very, very limited. Where there is a real difficulty is why should you do that? Well, the short answer is because probably that's one of those things where you can be a hero for your company. You can be the man of the year that literally generated 1% extra of margin company-wide in absolute terms. So it's not 1% extra. So it's not like the margin goes from 1 million to 110. It's literally, if you're $1 billion business, 1% can mean 10 extra $1 million. So it's one of those areas where, as an employee, you can generate, returns on investments that are like 1,000 times your salary. So, and I would say my advice would be, yes, it's risky, but if you want to be ambitious and to be able to negotiate, that next year you want to double your salary, that you need results, and you need relatively impressive results if you want to be able to negotiate sort of things. So if you want to be able to, in your career, to be in a position to progress enormously, you need to deliver, massive results as well. And in supply chain, usually you can, just because due to scaling effect and due to the fact that a financial optimization can generate, just due to the fact that you're operating in a potentially relatively large company, you can have like a leverage effect where your action just save millions to the company. And then, well, if your employer doesn't want, is not even willing to consider that it deserves a pay raise at some point, you need to change of employer. But usually, large companies are not idiots. I mean, when there is a team that managed to deliver fantastic results, it's just common sense that you kind of want to keep them on board. And large companies might have a lot of defects, but this is not the sort of problems that many large companies suffer. I mean, my observation is that large companies are pretty capable of rewarding very generously people who bring tons of money back to the company. So my suggestion is that, you see, as a supply chain person, you can be a person that does stuff that nobody cares about, which is optimizing persons, nobody cares about, or you can optimize dollars of return. And if you do it well, even the CEO of your company will pay attention. So my suggestion is, yes, there is a lot of risk. Yes, it's very difficult. But if you really care about your company and if you have ambition, go for those dollars of return, you will probably, not everybody will like you for that, sorry, but overall, I believe that can be something very transformative for the better for the company.
Okay, we'll have to wrap it up there, but I guess that's a good tagline. Optimize in dollars of return, you become hero of your company and you double your salary. It's not bad.
Make a few enemies along the way, but you know, it's hard to do anything if you never make any enemy in your life. It's probably that you never did anything in your life either. So you have to accept that. That's the downside of actually achieving anything.
Okay, we'll have to wrap it up there then. But thanks very much for watching, and we'll see you again in the next episode. Thanks for watching.